Welcome to FT Markets. Liquidity is one of the most widely discussed topics at the moment. Definitions are a little hard to come by, but most allude to the ability to buy or sell an asset without drastically affecting its price. With me here today to discuss liquidity is Isaac Chang, Global Head of Fixed Income at KCG. Isaac, welcome.
Thanks, Joe.
So, everyone's talking about liquidity. Should we be surprised that there's less liquidity in markets?
No, I don't think so. I think there are two main reasons why this is the case. Firstly, we've seen increased uncertainty around the forward path of monetary policy by central banks globally. As volatility increases, you should expect to see most metrics of liquidity decrease, whether you measure top of book size, market depth, what have you. This is the sign of a healthy and functioning market. As the markets get more volatile, you should expect to see the market dynamics change. If they didn't, that, in my mind, would be a more concerning problem. The second is that global regulators have taken risk and leverage out of the financial system post-crisis, since 2008, and liquidity or market making or liquidity provision is a business which requires capital. So it seems then if you look at the pre-crisis world, the liquidity actually that people now nostalgically refer to was actually implicitly subsidized by the taxpayer and not a sustainable or, from my perspective, a good model to go back to.
Okay. So the lack of liquidity has a lot of people a little apprehensive perhaps, especially going into potentially the first sort of rate rise we've seen for a while in September. One of the sort of main talked about concerns is the sort of people running for the hills, redemptions from bond funds as rates rise. Should we be concerned about the lack of liquidity? Is it a problem?
So, no amount of liquidity in the marketplace can keep you from losing money if you have a bad trade on. If the market comes to expect that the Fed is going to hike 100 basis points in September and you're long the bond market, you benefit from yields falling or even staying stable, you should not expect to be able to get out of your trade without a loss. Liquidity provision and market making reflects the best price, fair price of an asset given the information we have at any point in time. As information changes, the price of the assets change. No amount of liquidity is going to change, would actually change that.
Okay. So then we've also heard a lot about potential solutions to the lack of liquidity. The rise of a number of bond platforms trying to connect buyers and sellers without using dealers necessarily as intermediaries. What do you see as the solution to this?
So I would start by saying I think absolutely the wrong solution would be to roll back regulatory change, to go back to the world where we had a small number of systemically important liquidity providers that dominated the fixed income markets. Instead, we should be focused on creating a more diverse, vibrant, and broader ecosystem where there's a larger number of market participants providing liquidity, and the system is resilient enough such that the failure of any one of those participants does not threaten the system as a whole. And I think as we focus on increasing things like pre and post trade price transparency in the fixed income markets, as we focus on removing other artificial barriers to entry, what you'll see is entrepreneurial models come to the fore, which will fill the liquidity gap. For example, at KCG, we've launched a wholesale treasury market making business focused at dealers, which has gotten a lot of interest and traction over the last, and seen a lot of growth over the last 12 months, primarily because of the lack of liquidity and our ability to provide a solution to this part of the problem.
Isaac Chang, thank you.
Thanks, Joe.